Okay, it's 8:59. We do have Sarah and Kathy on also. Jerry?
So I believe we have a quorum, so why don't we just wait another
Oh, 1 more
30
minute.
seconds and then Don can kick us off with a roll call. You guys can hear me okay, right? Loud and clear?
Yep.
Yeah.
Everything.
Okay. It's 9 a.m., April 23. I call the meeting to order. And Don, if you could do a roll call.
Of course. Jerry Abrahams,
Here.
Phil DeFranzo, Zani Imitowski, Catherine McKinnon,
Here.
Commissioner Perez, Franklin Perry, Sarah Sanders.
Here.
We do have a quorum in attendance for this meeting.
All right. Thank you, Don.
I'm sorry, just as a reminder, we are live streaming and recording this meeting. Both of those processes have already started. And if any board members that are attending virtually need to leave the meeting at any time, please post in the chat or otherwise let me know, as we may be taking votes without a roll call, and we need to comply with statutory requirements regarding virtual public hearings. Thank you.
Thank you, Don. Thank you, everyone, for attending. Again, I apologize for not being there in person. I do expect to be attending, if not all, but most meetings, at least the latter half of the year in person, and strongly urge others who can attend in person to try to attend in person. I do think it's better for the organization, but I recognize it's hard to attend in person. I'm not there today either. So Hazim, if you could kick us off with our first two action items.
Sure. Good morning, everybody. So the first resolution that finance will be seeking the board to approve would be to authorize CHFA to issue up to 375 million of the housing mortgage finance program bonds in one or more issuances. The sale will allow CHFA to raise additional lending proceeds and fund about 1,272 first-time homebuyer loans. As of April 14, CHFA had an aggregate net pipeline of about 270 million, Based on the interest rate environment, CHFA plans to utilize a structure consisting of fixed rate and variable rate, and expect to close the issuance in or around June of this year. To leverage CHFA tax-exempt issuance capacity, CHFA intends to blend the tax-exempt proceeds with taxable bonds. CHFA has informed Wells Fargo Securities to lead the second single-family financing in 2026. I'm happy to answer any questions regarding the proposed resolution.
Okay, before we take questions, can I get a motion?
So moved, Sarah.
Thank you,
Second.
Sarah.
Second.
Thank you, Catherine. Any questions? I have two. So Hazim, when will you go into the market?
We plan right now based on the information we have, probably the end of May.
Okay. And Wells Fargo is Nick Floor?
Yes,
They do.
and he's in the building.
Okay.
Hi, Jim.
Hey, Nick, how are you? You guys always do a good job. Anything really unusual about this one, or it's like straight up the middle here?
Nothing unusual other than we try to remain flexible so that if in an event the market moves, depending to what that means, we may tinker with the structure to accommodate the prevailing market.
So you'll, so after, assuming the board passes your resolution, which I have no doubt that it will today, you could be in the market as early as next week or the week after?
No. I think in terms of like our due diligence in trying to formalize the structure, submitting the proposed structure to the rating agency for their review. So there's a few things that we have to do. So
Okay.
the years I think would still be around the end of May.
Okay. Any other questions? Okay. Can we do this by voice vote, or do we have to do a roll call?
Yes, no, by voice vote's fine, Jerry.
Voice vote. Okay, so all those in favor say aye. Aye.
Aye.
Aye.
All those opposed say nay. Any abstentions? Okay, carries unanimously.
And Jerry, I just want the record to reflect that I joined the meeting a few minutes ago.
Okay.
This is George.
Next item.
Okay. Thank you. So the second resolution is to authorize CHFA to recapitalize the Habitat for Humanity loan program by $5 million. By way of background, CHFA in 2009 established a loan purchase program to assist Habitat in providing liquidity through the purchase of 0% mortgage loans made by Habitat and sale of new or rehab homes to low-income homebuyers. The program leverages CHFA's balance sheet and allows CHFA to partner with local communities to revitalize neighborhoods and provide access to homeownership. Last June, the board approved a recapitalization totaling $5 million. Since that approval, CHFA has purchased 26 loans totaling $5.3 million. To illustrate the impact of the program, we do have two examples of recent purchases that CHFA did. One was with Coastal Fairfield County, where they built 4 duplex homes. So here what you see in front of you is a news release by a local paper highlighting the impact by Habitat. So the project that they did was their very first project in the town of Fairfield. CHFA purchased those 4 loans back in February and March of this year. The second was with North Central Connecticut, where they built 10 single-family homes on a site formerly belonging to a redevelopment agency. So here you can see where the site, and we have purchased 8 of those 10 loans so far. So you can see there from the site, the bill, and then if you go to the next page, that's the whole. So we believe that this has been a very successful endeavor, and I'm happy to answer any question regarding the resolution.
It's Phil DeFranco. I have a question. So these are zero interest rate loans?
No, zero. For that,
No interest.
correct.
And do these all follow the same background as like what the Habitat for Humanity, like the people who are buying have to put in a certain number of hours of equity into the property?
Yes.
Okay.
Yes.
Great program.
Great program.
I have a question too. Oh, go ahead, Jerry.
Yeah, let me get a motion first, and then we'll
Oh,
have time
okay.
for questions. So can I get a motion to approve?
So
I'll move
moved.
to approve. All right.
Second,
I'll
George.
second. Go ahead, Sarah. Thank you.
So I'm curious. So who originally originates the loans before we buy them? They have local banks they work
No,
with, or do
no,
they do it their themselves?
It is by themselves.
Oh.
Each affiliate has their own program, but essentially they do operate in a similar way where the first requirement would be you have to be income qualified. So they have a particular definition in terms of how you meet those income qualification. And then of course they want to make sure that you satisfy certain requirements such as contributing your sweat equity to build a house, and then other things that from a programmatic standpoint in terms of what they would like to see from an impact perspective.
Well, I think it's a great program too. Who services the loans after we buy them? I'm just curious.
We are currently partnering with Capital for Change, or C4C.
Okay. Nice program. You should announce your participation because it's a really good feel-good program, I think.
Let's see, I have a question.
Hazim, I have a question. The 5 million comes from ITA?
Yes.
Okay. And why 5 million?
So when we came out with that number, it was just based on what they have done in the past. If you remember last June, one of the things that we did also, in addition to recapitalizing by 5 billion, we also changed the requirement of the program to make it much easier for them to participate. So recently, we actually did have a meeting with Coastal Fairfield County, and they did ask us to see if we would be able to support in excess of 5 million. So this is something that we just want to discuss internally before we present something to the board, whether or not we should upsize it in excess of 5 million.
All right, I mean, the programs, and I won't jump ahead of that conversation, but maybe if we think that the mission is useful and we have the resources, I know we do,
Yeah.
something to consider. So 5 million seems low just initially at this.
Right. And I think you're just reacting based on what we have done since last year. So that is something that, and again, when we based the first 5 million, it was just the amount of loans that we were getting from them, because they were also facing other obstacles just to get those homes built. So if there's more interest by the affiliates to access our program, we definitely will take a hard look and make the proper recommendation to the board.
Okay, thank you. Commissioner Perez?
Yes, I'm going to caveat my questions with sharing with you all that,
Commissioner, did you have a question?
yes, I do. I'm trying to explain something before I ask the question. Can you hear me?
Yes.
Okay. And I'm saying I'm going to make a statement before I ask my question because I don't want
I don't
nobody to
hear
misunderstand my
anything.
question. I've been very involved with the Habitat for Humanity in New Haven. In fact, I was one of the founding members, and I won their Master Builders Award. I volunteer, giving them money, the whole thing. Now, having said that, at least with the New Haven affiliate, which is the one I'm the most familiar with,
All right. Any other questions?
I'm trying to ask a question. You cannot hear me?
Yeah, so we can hear the commissioners.
Okay.
I can't hear for some
Yeah,
reason.
but Jerry keeps on, cutting me off. So my question is, why are we competing? I mean, I'm familiar, at least with the New Haven affiliate, there are a lot of banks that actually not only buy these loans at 0%, but they actually give them donations so they don't have to have a mortgage. So are we competing with other entities with the limited resources that we have?
No. So it is a choice by each affiliates, and like you mentioned, Commissioner, like they may, if they feel like it makes more sense for them to either hold it on their balance sheet or partner with a local community bank, it's definitely their choice. So the purchases that we have done since last year are purchases that they approach us to see if we had any interest to buy them so that they can have the liquidity to start on their new project.
Okay, but if they find a better deal somewhere, we're not going to punish them and say we're going to take away your line because you haven't done, X amount of loans with us in the last year.
No, that's no benchmark, there's no performance, there's no KPI. This is more of what we view as our side quest to partner with local communities so that they can assist the population that they serve.
And I'm totally for that, and I understand that. But the point I'm trying to make is if there's private money out there that's also wanting to do that, we should not compete with that. That's what I'm saying.
Understood. Yes, and I think that we always encourage if we can partner with other entities such as local banks or even the state if they want to match our funding to finance this program, we will embrace it.
Because, like, for instance, in the New Haven affiliate, there are banks that actually pay for the entire cost. They sponsor the house. So
Yes.
technically, there is no mortgage at the end. Now, they still charge some sort of price to the individuals buying the home or getting the home. Because, you got to have some skin in the game.
Right.
All I'm concerned about is that we're not competing with private equity, private industry because we got limited resources, and we could put our resources into the more difficult deals.
Yes.
That's all.
We
Thank you.
we totally agree.
Yep. I'm done now, Jerry.
Jerry?
Okay. Yeah. For some reason, I can't. I don't know if Sarah, you can. I can't hear the commissioner. Just the boardroom.
Okay.
Yeah, I can hear him. I'm not sure.
You can hear him. I
And I am
couldn't
a
hear him
board
for some
member too,
reason. It's
Jerry.
kind of strange. Okay. Any other questions? And if I can't hear, I apologize if I missed someone. If you could just make sure Hazim knows and he can let us
Yep.
know. Any
right.
other questions? Okay. Hearing none, unless I can't hear it.
You're good.
Hearing none, we'll go to another voice vote. All those in favor say aye.
Aye.
All those opposed? Hearing none. Any abstentions? Hearing none. Dawn, it passes unanimously.
That is correct. Yeah.
Thank you. Okay, reports.
Okay, reports. So the first two reports is about the audited financial statements. So we have this morning with us again from Whittlesey, Tom Goldfuss, and Katrina Olson. But before I hand it off to the two of them to talk about the 2025 audit result, I just want to give a quick preview of the financial statements. So on April 6th, we received an unqualified opinion or clean audit on our financial statements from our external auditor. In terms of the information, I'll be providing a high-level recap of 2025 activities. So this supplements the information I provided last November to the board during the budget presentation. CHFA funded 3,788 homeownership loans totaling about $1 billion compared to 3,873 loans totaling about $1.1 billion in 2024. For multifamily, CHFA provided financing totaling about $196.4 million to support 1,168 affordable units, compared to $234.9 million to support 1,201 affordable units in 2024. Non-current asset increased to $6.6 billion from $5.6 billion, while the corresponding bond payables increased to $6.3 billion from $5.4 billion. Of the $6.6 billion of non-current assets, $4.2 billion were MPS, or about 62%. So this information is in our management discussion and analysis, so feel free to read at your leisure. But before, again, I pass it to Tom and Katrina, does anyone has any question?
Any questions?
If not, Tom and Katrina, please take it
But,
away.
Hazim, before we do that, I just also want to let the other board members know I did also speak separately with Tom and Katrina earlier this week without staff, just to make sure that they had an opportunity to raise any issues or anything material that they thought the board should specifically be aware of, and they did not raise anything. So, okay, Tom, Katrina, you guys.
Great. Thanks. Good morning, everybody. Thanks for the intro, Hazim. We'll get started with our summary document. Just to summarize, you guys had a great year and the audit went well as well. No surprises. The management team within the organization is great, easy to work with, provided us with everything we needed. So all good news on our report. I think that this looks like the audit. Can we skip ahead to the summarize?
Lori, is the next tab.
Yeah.
So you have to go to this is still
it would take a tremendously long time to go through the audit. Very lengthy audit.
Page 92, that helps.
92, Lori. Okay. Yep.
Perfect. Yep. You can even skip to the next page. I'll start with our team. So great. So our audit team, we have a large audit team. This, believe it or not, is just a quick, it's more of the higher level people in the audit. But we provide this so that you have our emails and phone numbers for the year, and just so you know who's doing the audit. We have a few managers on it. One thing that's unique about our firm is we always engage internal IT support to do our audit work. So there are certain audit IT requirements that we have as part of the audit, but they'll go a little further to make sure that some of the other things that the organization should do, specifically around cybersecurity, are handled. And while it's not an intense audit or any audit opinions are released on it, they do make sure that our clients do have certain minimum protocols in place and best practices. So nothing came as a result of that, but we do a little bit more than just the financial statement audit when we look at some of these controls. One thing that I think is relevant in this day and age is the risk of cybersecurity and other IT risks. It's not just balance sheet risk management anymore, but the IT component plays a large role in that too. So that's why we coordinate it with our internal resources. And as an audit committee, if you're looking at risks, IT should certainly be at the high level as it is with every organization. But nothing came as a result of that we need to report to you. I just wanted to spend a couple of minutes just to explain some of the work that we do on that. The next page is our audit results. We could probably hit this pretty quickly. It was a clean audit report, not only on the financial statements, but also on our other audit reports. which consists of the Government Auditing Standards Report, which is a report on internal controls and compliance over financial reporting. So everything is still working and controls are in place, and no exceptions noted there. And then we opine on your compliance for major state and federal programs. No compliance findings or significant deficiencies were noted in that audit. So on top of a clean financial statement audit, you also have a clean opinions on federal, state, and Yellow Book reports. No misstatements noted that required any correction. And the next page goes over some more required communications we have. As I mentioned, clean audit reports. We communicated our approach under generally accepted auditing standards and government auditing standards within our engagement letter this past October. We also met with the audit committee and board prior to audit work beginning. Nothing came to our attention. Nothing changed our audit approach. There was nothing that came up that made us pivot and do additional work. So again, like I said, everything went smooth. There are no new significant accounting policies adopted by CHFA during the year, and existing accounting policies were not changed. Management provided us with a management representation letter on April 6th. Pretty straightforward there, nothing unusual. As part of the audit, we've looked at certain accounting estimates. The most significant estimate is the allowance for uncollectible loans, net pension liability, net OPEB liability, and fair value of the swap portfolio. Nothing came to our attention to indicate any bias or any unusual assumptions or inputs being used to calculate those amounts on the balance sheet or on the income statement. Previously mentioned, no audit adjustments. There were no unadjusted differences either. That would be a misstatement that we're aware of that did not get corrected, which we would report to you. So no adjustments there. The audit, as we've mentioned in our initial planning communications, is not designed to catch fraud or illegal acts, but it is a consideration of our audit, and we do have to design certain procedures to consider the risks of fraud or illegal acts, but nothing came up, nothing was identified or seemed out there. There were no material weaknesses identified in internal controls. We did not have any difficulties in performing our audit with management. There were no disagreements, and we're not aware that they disagreed with anything we said and shopped around to determine if anything we said was fair. And then finally on this slide, in order to do our audit, we have to make sure we're independent with respect to CHFA. We do that analysis prior to beginning the audit, and then we also make sure that during the course of our audit that we remain independent, and that is true. So we can positively confirm to you that we've maintained our independence. It's worth noting with this section 2 under independence that one of the areas that could blur independence is our potential involvement with preparing your financial statements. We can do that in certain instances with certain safeguards. However, your accounting team led by Allison does prepare the full set of financial statements, at basically 100% level. We review those financial statements, obviously as part of our audit, and we provide feedback and become another set of eyes just before they get finalized and published. But the product you see is produced internally by CHFA, and it's a really good product relative based on the size of the organization and the complexity. I just want to compliment the team, obviously led by Hazim and Dini, that you guys are doing a really good job producing financial statements. So compliments to the organization for that. The final page on communications is, if you go one more page, is additional information as part of the audited financial statements. Sorry, can you go back one more page? Yeah. As part of the financial statements, there's additional information which consists of required supplementary information, which is the management discussion and analysis. There's also information regarding the pension and OPEB liabilities with the state. That information is part of our audit. Different auditing level is performed on both. We don't issue separate opinions, but We are responsible to make sure that that information is consistent with the financial statements, that it's not misleading, that it complies with generally accepted auditing principles, which includes GASB. But there is no, while no opinion was expressed on that, there were no issues identified in that information. The schedule of expenditures of federal awards and state financial assistance is also included in your financial statements. They're separate documents, but they go hand in hand with the audited statements. There were no issues in those reports, again, unmodified reports. And then finally, with respect to the combining individual fund financial statements, which is supplementary information on your financial statements, we do reconcile that back to the audited financial statements themselves to make sure that it agrees, that it complies with the required standards, that it's complete and accurate. And our reports on that were also issued April 6th. So I will hand it over to Katrina. And again, I think we have time for questions at these two. So I'll let Trina take over from here.
Oh, great. Thank you, Tom. And good morning, everyone, again. The next slide, please. The next two slides, I'm just going to provide an overview of our significant audit areas and our procedures that we performed. So to address the inherent risk of management override of controls, we did gain an understanding of the authority's internal controls over financial reporting, which includes the areas you see there on your screen. We did perform testing over those key areas, some examples including a sample of journal entries, a sample of wire transfers, payroll, cash receipts, and cash disbursements. For cash and cash equivalents, we confirm a selection of the cash accounts held by CHFA, and we test bank reconciliations for accuracy and any reconciling items. For investments, we also confirmed a selection of the investments, and we tested the fair value of the portfolio. And this testing included taking a sample of securities to test pricing and the accuracy of pricing. For the interest rate swaps, which is a derivative instrument, we did rely on BLX's valuation and swap effectiveness calculations. We also tested the balance in deferred inflows related to these swaps. For mortgage loans receivable, we agreed the loan balances to the detailed subledger systems for agreement. We also performed analytical testing over loan interest income. A significant estimate, as Tom mentioned, is the allowance for loan losses. We did perform testing over that. We evaluated management's methodology for calculating that significant estimate. And this included taking a sample of loans with a specific allowance assigned for detailed testing. We do perform tests of controls, internal controls over the single family and multifamily programs to determine if the controls were operating as designed. And we also perform testing that CHFA is monitoring loan servicer organizations. For bonds payable, we confirmed a selection of the outstanding obligations at year-end and performed analytical testing over the reasonableness of the related interest expense. And we also performed detailed testing over the recording of the new bond issuances in 2025. Next slide, please. As Tom already mentioned, for the net pension liability and net OPEB liability, we do review the assumptions used by the state of Connecticut actuaries, and we agreed the liabilities recorded in the authority's financial statements to the plan's audited schedule of employer allocation for the authority's proportionate share of those liabilities. For revenue recognition, we do perform detailed testing of revenue collections to gain comfort over the loan collection process, as well as to gain comfort over the reliability of the transaction data, and that's used to validate our other analytical procedures over revenue. And then finally, as Tom mentioned, the federal and state single audits, those are separate reports where we're performing testing over the direct and material compliance requirements over major federal and state programs. So when we perform those tests, we do select major programs to test. So what that means is for example, for federal single audit, we tested the Department of Treasury Capital Magnet Fund. And then for the state of Connecticut single audit, we tested 3 major programs, which included the DECD Housing Trust Fund, the Department of Housing Emergency Mortgage Assistance Program, and the Department of Housing Time to Own Program. So that testing entails we look at the direct and material compliance requirements and also internal controls over compliance. And as Tom mentioned, we did not note any findings. Next slide, please. So our last slide is just a few technical updates. Just important that management and the board be aware of these GASB updates that are in effect. The first 2 are in effect right now in 2026 for the authority. So GASB 103 is financial reporting model improvements. So this is intended to improve key components of the financial reporting model, notably the management's discussion and analysis. So your MD&A will look different for the 2026 audit process. The GASB is prescribing certain components be included in the MD&A. And also there's some new requirements to separately report in your financial statements any unusual or infrequent items. GASB number 104 is disclosure of certain capital assets. So not a big change here, but it could impact your footnotes where there's requirements to separately report any leased assets, subscription assets, or other intangible assets, or any capital assets held for sale. So those 2 are in effect for 2026. For 2027, subsequent events is GASB 105. And that just clarifies the subsequent event time frame and provides definitions on the what is considered a recognized versus a non-recognized event. So that will be in effect for 2027. All right, so that concludes our planned remarks. Were there any questions for us today?
Any questions? Okay. Hearing none. Thanks, Tom. Thanks, Katrina.
Thank you, Jerry.
Thanks. Welcome.
Good work, guys.
Thank you. So the next item is to just provide the committee, like usual, after we have conducted a bond sale. We just want to share our experience. So here we have this morning with us is
And what is that one, Joe?
Aitano, who is the executive director from Morgan Stanley, and she's going to describe the 2026 Series B transaction that we use to finance multifamily. So Ollie, why don't you take it away?
Great, thanks Nazim, and good morning, members of the board and finance committee. So before I get into the pricing results for the CHFA's 2026 Series B transaction, just to give a little bit of market context, in the weeks leading up to the pricing, which was on March 10th of this year, there was elevated volatility in the broader fixed income market. And I would characterize the market as being very headline driven, for the majority of this year so far. U.S. Treasury yields were driven by 2 competing forces, sharp rise in oil prices tied to the geopolitical issues and war in Iran, and materially weaker than expected employment report, which dovetailed into most projections of interest rates going to interest rate cuts later in the year, and most of the market pricing in about, 1 to 2 interest rate cuts. Despite the volatility, the market remained, pretty constructive. We priced the 2026 Series B on March 10th, which was actually great timing. And, timing is everything in this market, I think, because the following day investors became a little bit more selective, particularly in the intermediate part of the curve, and the municipal market data tax exempt curve increased across the board. So I'll just go into a little bit of the pricing results. So the Series B was 149,685,000, broken into 3 subseries. Subseries B1 were tax exempt bonds, totaling 3.9 million. Those were long-term bonds, a mix of serial and term bonds. The subseries B2 and the subseries B3 were both short-term in nature, which in this market, investors, have a lot of demand for. And so those 2 totaled about 125.7 million. The subseries B3 were issued as federally taxable floating rate index notes, which I'll get into a little bit more. But starting with the tax exempt subseries B1, we had, as I mentioned, some serial bonds and par term bonds. That whole series totaled 23 million. We ran a retail order period, and as always, Connecticut housing had strong retail demand. We had 67.6 million in retail orders. And Morgan Stanley is a big, wealth management shop. We placed about 45% of those retail orders throughout the state. 80% of those were in state in Connecticut, and the rest national retail. Because of the strong retail demand, we were able to tighten spreads by 5 to 10 basis points across the serial bonds, and then 5 basis points across most of the term bonds, 10 basis points on the 2046 term bonds. That was following the retail order period. And then in the institutional order period, we continued to have good demand for the bonds. For the subseries B2, which was a put bond with a 3-year mandatory tender, we tightened that by 5 basis points following the institutional order period. Most of the transaction was oversubscribed, an average of 2 times oversubscribed. And then just of particular note, the subseries B3 bond. We did a fair amount of price discovery on this because there are not very many federally taxable floating rate bonds in the market. We ended with a spread of 50 basis points to the SOFR index, which was the tightest spread that an FRN has been issued in the market in quite some time. The New York City Housing Development Corporation did an FRN or issued an FRN several months before, and their spread was 59 basis points to SOFR. So we thought that was a very successful sale, and particularly of note, we were expecting that the Federal Home Loan Bank was going to take the whole 75 million, and they did put in an order for the entire thing. However, 2 institutional buyers, Eaton Vance and SIT Investment Associates, were also interested. And so we ended up splitting the order there. So that was, a good result, showing investor diversification on that bond. On the first page, on the bottom of this page, you can also see that the other transactions in the market pricing that week were State of New York Mortgage Agency and Maryland Community Development Authority Agency. And Connecticut's pricing went very well compared to both of those transactions. I think we were, almost an average of about 5 basis points through or on top of those other transactions that week. So maybe I will stop there and see if there are any questions.
Hazim, did we swap the FRNs?
We did not.
Any other questions so far?
Why not? Don't you usually swap your variable rate, or maybe not?
So because this is a very short-term variable rate, and using it to fund a bridge loan along with construction.
Okay.
Oh, just for construction. Okay. Any other questions? I see that. I know that the pay. Are you? I did notice in the pricing book. I forget what page though. It looks though that your spreads were really tight versus historical. Is there any explanation? I mean, it's great. Any explanation as to why?
Generally, so housing spreads have been tightening. We've seen that, over the last, I'd say, 6 months to a year. But I think a couple of things here, even despite the volatile market, this was also a smaller deal, and most of 125 million of the 149 million was in the short-term range. The 3-year mandatory tenders, investors were really, had a high demand for that, which we also heard. Morgan Stanley did a housing investor conference yesterday, and also heard that from very big buyers such as Vanguard, that they're looking for 3 to 5 year, tenors all day long, and are also interested in more FRNs, which is, interesting. So I think that's just kind of the general end.
Yeah, but even on the long end, right? So you right, I understand why the short stuff, but even on the long end, and again, it's great. But it's like, really, the B1s were 40 bips spread to MMD. So I don't know for that structure or just as you said, the housing bonds are tightening. I assume housing bonds are tightening because just the asset classes is in vogue, or is it are housing bonds tightening relative to other tax exempt classes, or it's just part of an overall tightening of muni bonds?
I think it is the combination. So one of the things, Jerry, when you look at the spread analysis, we are also comparing between multifamily transaction and single family transaction. And multifamily, there's some investors that they understand in terms of the prepayment risk and just the fact that it's being backed by tax credit, whereas for single family, they do prefer that lockout so that they can understand what would be the duration of their investment. And then, like Ollie mentioned, the other thing too, multifamily issuances are generally much smaller than single family. So when you do have demand and you don't really have a lot of paper out there for CHFA for that particular issuance, so it somewhat drives that spread.
Okay. I mean, it's good. I mean, look, I get the multifamily versus single family.
Yeah.
Any other questions by the board? All right, hearing none. Thank you, everyone. Good job, guys. Excellent job.
Thank you. So the next one is the financial reports, and I'm just looking at the time, so I'll go quickly. Like I mentioned to Jerry right before the start of the meeting, Allison wasn't able to make today's meeting, so I'm presenting the financial reports. So for the first quarter of 2026, mortgage loan and interest from investment revenues are approximately 1 million below budget, and is coming in 12.4 million higher when you look at a year-over-year comparison. The portfolio for investment is definitely 1 billion higher than last year. And that's essentially what's driving the variance. So for the expense side, it's essentially a similar story where interest expense is 4.4 million below budget, but higher when you look at it from a year-over-year by 11.6 million. Outstanding bonds or bonds payable were 1.07 billion higher. And when we look at the administrative or operating expenses, it's coming in, 1.9 million below budget, but close to 800,000 higher than the prior year. When you exclude salaries and benefits of 7.8 million, when we look at the year-to-date, it's only about 82,000 lower than what we experienced last year. Overall, the change in net position is above target by 3.7 million. I'm happy to answer any questions regarding the first quarter financial report.
Questions?
No, just a comment that CHFA always significantly outperforms their budget, and they're doing it again.
Well, one of the things, Sarah, keep in mind, we do utilize a straight line analysis. So when it comes to comparing expenses or revenues, because of that straight line nature, when we do stuff, we just take the budget, we divide it by 12. So you do have that variance.
Timing.
But on the administrative expenses, to Sarah's point, we will be under again, and that's because we have open positions that, personally, I'd rather see filled. We have the resources, and I'd love to see those positions filled, and maybe less.
We definitely have open positions, Jerry, and I think that what's driving whether or not they get filled is whether or not they get filled in their current vacancy area, because sometimes the need across the authority will vary based on a new program or, a new need that's, been identified in terms of what the position actually should be doing. So I think, I don't know that that's actually driving some of the administrative short overages in the first quarter, but it may be a timing issue more than anything else. Because we don't budget for 148 positions with 133 headcounts. In other words, we have to manage within what would be considered an appropriate percentage increase in a year-over-year analysis of the budget. So we have to. There's some balls that we're managing in terms of like how we budget for open positions.
It does seem though we have, though, my understanding, and correct me if I'm wrong, is that we do have a bunch of open positions that does lead to some of the upside budget performance. But again, I'd rather, and it may not be it's not the sole reason. I get that, and you guys have done a really good job controlling administrative expenses, especially relative to the size of the assets, which is what matters the most, right?
Sure.
And that's all good. But again, if we have open positions and they could be, serving the organization's mission, it just seems to me that we would want those filled and having more resources available to complete the mission.
Absolutely. And we set about filling requested positions or needed positions as soon as they're identified, and it happens in the processes that resulted those position postings are occurring all the time and are based on business needs. So hopefully that alleviates any concerns about vacancies.
Okay. Thank you. Questions? Any other questions? Is that all reports, Hazim?
No, we have two more.
I thought
So
so. Yeah.
John Chilson is going to talk about production and delinquency.
All right. Good morning. I'll go quickly. For the month of March, the authority purchased 374 loans for $107 million. The total production for the first quarter was 277 million, which is 22 million less than the first quarter of 2025, but purchases still remain on a very strong trend. 96% of March's production was securitized, leaving 15 loans, $4.4 million as whole loans. The MBS portfolio ended the month at $4.5 billion, which is an $83 million increase over February. The whole loan portfolio for February declined by $3.7 million, with it remaining at a overall portfolio balance of $1 billion. The whole loan delinquency rate was at 7%, which continues to remain lower than the state and nationwide averages. And our carrying balance of loans in foreclosure year over year has declined by about $2 million, ending with a balance of less than $12 million. And for the month of March, the authority purchased 88 down payment assistance loans, totaling just under $1 million, and 188 time to own forgivable loans at $4.4 million. Our multifamily portfolio, there was one new loan closing in March. The portfolio remained at a loan count of 627 loans, totaling $1.6 billion. There are 7 permanent loan delinquencies, and the delinquency rate for the multifamily portfolio is still less than 0.5%. Any questions?
Questions?
Hey,
Thanks, John.
yep, Ning Yang.
Okay, I'm gonna report on the investment result. At the end of first quarter, the authority's overall investment portfolio totaled $6 billion. This is an increase of $620 million from prior quarter. Program assets reached $4.5 billion. This is an increase of about $200 million from prior quarter. Weighted yield to maturity is 4.33. This is slightly lower than 4.36 of the prior quarter. On the swap side, the authority entered into a new swap with JP Morgan Chase Bank in February. This is a notional amount of $64 million. It hedges a portion of the 2026 A3 variable rate bond. There are currently 43 swaps with 9 counterparties. Total notional amount is about $1 billion. Weighted pay rate is 2.851%. Overall mark to market is $54 million. This is in the authority's favor. I'll be happy to answer any questions.
Any questions for Ning Yang? Jerry?
Okay.
Yep.
So thank you, Hazim. Thank you, Ning Yang. Any other matters that any board member wants to bring up?
Minutes, Jerry.
Oh, I need a motion. Thank you, Hazim. I need a motion to approve the minutes. Any comments or questions on the minutes? Okay, can I get a motion to approve the minutes?
Move, Sarah.
Thank you, Sarah. Second?
Second, Kathy.
Thank you, Kathy. All those in favor?
Aye.
Aye.
All right. Opposed? Hearing none. Abstentions? Hearing none. It passes unanimously. Okay, that concludes the agenda. Any other items that any board member would like to bring up? Hazim, any other thing from your end?
No, we're excited to see everybody at the May meeting retreat. So yeah, that's pretty much it from.
Okay. Excellent. Well, we just have a couple minutes to refresh our coffee. The chair will make a motion to adjourn. Can I get a second?
Second.
Okay, thank you. All those in favor? Aye.
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 Opposed? Abstentions? All right. Thank you, everyone. Talk to you in 2 minutes.
Good. Thank you.
Bye.